Welcome to our deep dive into the essays of Warren Buffett. Did you know that Warren Buffett's net worth is over $100 billion, yet he lives in a modest house he bought in 1958 for just $31,500? Surprising, right? Buffett's unique approach to investing has made him one of the richest people in the world. In this video, we will reveal some of his lesser-known strategies that have helped him amass such wealth. We'll explore his philosophy of value investing, his knack for going against market trends, and his views on corporate governance. We'll also share some of his biggest mistakes and the lessons he learned from them. Stick around to discover how you can apply Buffett's timeless principles to your own investments. Whether you're a seasoned investor or just starting out, there's something here for everyone. Get ready to unlock the secrets of the Oracle of Omaha and transform your financial future. 1. Buffett's billion-dollar blueprint: unpacking investment philosophy. Warren Buffett, often hailed as the Oracle of Omaha, has a straightforward yet profound investment philosophy that has guided him through decades of successful investing. At the heart of his strategy lies the principle of value investing, a method that involves picking stocks that appear to be traded for less than their intrinsic or book value. Buffett once famously said, "Price is what you pay. Value is what you get." This simple idea underscores his approach to investing. Focus on the real value of a business rather than short-term fluctuations in stock prices. Buffett emphasizes the importance of looking at companies with a moat. This term refers to a business's ability to maintain competitive advantages over its competitors in order to protect its long-term profits and market share from competing firms. For example, Coca-Cola, with its brand recognition and global reach, exemplifies a company with a strong moat, which Buffett values highly. Another cornerstone of Buffett's investment strategy is his preference for companies with exemplary corporate leadership. He believes that the quality of people running the business is just as important as the business itself. He often invests in companies led by management teams known for their integrity and business acumen. "It's better to hang out with people better than you," Buffett mentions, pointing out that good company improves your own standards. Investing, according to Buffett, should not be about trying to guess the stock market's next move. He advocates for a long-term perspective, often holding stocks for decades if not longer. He argues that if you aren't willing to own a stock for 10 years, you shouldn't even think about owning it for 10 minutes. This approach has helped him avoid reactionary decisions based on market volatility. Buffett also warns against the dangers of high fees and investment advisors who promise high returns but underdeliver. He has noted that passive investment in index funds usually outperforms managed funds in the long run. This is due to their lower fees and the market's tendency to increase in value over time. As Buffett puts it, a low-cost index fund is the most sensible equity investment for the great majority of investors. To the contrarian's corner: why Buffett bets against the market. Warren Buffett's contrarian approach to investing can be summed up in his own words: be fearful when others are greedy and greedy when others are fearful. This philosophy has led him to make some of the most lucrative investments during times when market panic or euphoria clouded the judgment of other investors. One of the most iconic examples of Buffett applying this strategy was during the 2008 financial crisis. When most investors were selling their stocks at rock-bottom prices, Buffett was buying. He invested $5 billion in Goldman Sachs, which was struggling at the time. This move was seen as a massive vote of confidence in the bank and the market as a whole. The investment paid off handsomely as the market eventually rebounded. Buffett's approach relies heavily on his ability to detach from the emotional rollercoaster that often accompanies stock market investments. He views market downturns as opportunities to purchase great companies at a discount, rather than as signals to sell. His success, therefore, hinges not just on his unique strategy but also on his emotional discipline. This contrarian stance also highlights another Buffett principle: the focus on accumulating wealth long-term rather than seeking short gains. "Our favorite holding period is forever," he claims, suggesting that real wealth is built through sustained growth over many years, not by capitalizing on quick wins. Buffett's willingness to go against the tide has not just been limited to buying during downturns. He also avoids overly hyped stocks that have caught the market's fancy without having the fundamentals to back up their valuations. This discipline of sticking to the basics of value investing and ignoring the noise has allowed him to capitalize on opportunities that others miss. 3. Risk, returns, and rationality. Buffett on financial temperament. Warren Buffett's investment success is as much about his mindset as it is about his strategies. He once advised, "The most important quality for an investor is temperament, not intellect." This means that having the emotional fortitude to withstand market fluctuations and stick to your investment principles is crucial. Buffett's ability to stay calm and rational, ignoring the fears and fads that drive the market, has allowed him to capitalize on opportunities that others miss. He often talks about the need for a sound investment temperament that resists the allure of quick profits from market timing and short-term trading. According to Buffett, the stock market is designed to transfer money from the active to the patient. This perspective has helped him focus on long-term growth rather than short-term gains, a strategy that has significantly contributed to his overall success. Buffett also warns against the dangers of debt. He likens borrowing money to playing Russian roulette. Occasionally, everything may go fine, but continuing to play can catch up to you, or as he puts it, eventually, economic reality can be ignored by the market no longer. This philosophy underlines his risk-averse approach to investing, focusing on maintaining a strong financial base and avoiding the pitfalls of high leverage. Furthermore, Buffett encourages investors to understand what they invest in, a principle known as the circle of competence. He argues that one should keep investments within their areas of knowledge to avoid unnecessary risks. This practice has kept him from making investments in industries he does not understand, no matter how attractive they may appear from the outside. 4. Corporate governance. According to Buffett, a blueprint for CEOs. Warren Buffett places a high value on strong corporate governance. He believes that the integrity and efficiency of a company's management are critical to its long-term success. You've got to keep things simple, he says. But it's very simple to keep things complicated. By this, Buffett stresses the importance of transparency and simplicity in business operations and reporting. He often examines a company's annual reports and letters to shareholders to gauge the honesty and clarity of its leadership. For Buffett, the way a company communicates with its shareholders is indicative of its respect for investor interests and its overall corporate governance. He is known for his detailed, plain-spoken letters to Berkshire Hathaway shareholders, where he discusses not only successes but also mistakes. Buffett also looks for companies that have a shareholder-oriented culture. He praises CEOs who act like owners and are heavily invested in their companies, not just through salary but through significant equity holdings. This aligns their interests with those of the shareholders and leads to better management and oversight. His focus extends to how companies handle adversity. Buffett values leaders who can steer their companies through tough times without sacrificing long-term goals for short-term gains. He admires CEOs who demonstrate resilience and a steady hand in steering their businesses, reflecting his belief in character over charisma in leadership. Finally, Buffett's advice to managers and investors alike is to act with a keen sense of stewardship. He champions a business philosophy that regards shareholders as partners and treats their money with the utmost care and respect. When promised quick profits, respond with a quick no, he advises, highlighting his disdain for reckless financial decisions and schemes. 5. Buffett's failures. Lessons from investment mistakes. Even Warren Buffett, with his legendary investment prowess, admits to making mistakes, and he believes there's a wealth of learning in each one. He openly discusses these errors to help others avoid them. For instance, Buffett often refers to his purchase of Dexter Shoe Company in 1993 as one of his worst investments. He bought it using Berkshire Hathaway stock worth $433 million, which would be worth many times that today if not for the ill-fated investment. From this, he learned the hard lesson of not using precious stock to buy businesses. One of Buffett's key takeaways from his missteps is the importance of learning from experience. He famously said, "It's good to learn from your mistakes. It's better to learn from other people's mistakes." He emphasizes understanding why decisions were made, what went wrong, and how similar pitfalls can be avoided in the future. This approach helps refine his investment strategy continuously. Another significant mistake was his delayed investment in technology companies. Buffett stayed away from tech stocks because he didn't understand them, missing early opportunities in companies like Google and Amazon. This taught him the value of adapting and evolving his circle of competence to include new industries, albeit cautiously. Buffett also regrets his decision to buy Berkshire Hathaway itself, a textile company he turned into a conglomerate. He believes the initial investment diverted funds from more profitable ventures. This mistake taught him the critical strategy of recognizing when to cut losses on a bad investment and instead redirect resources to more promising opportunities. 6. The future of investing. Warren Buffett on trends to watch. Looking ahead, Warren Buffett predicts several key trends that will shape the future of investing. He is particularly keen on sectors that demonstrate long-term growth potential, such as renewable energy and technology. Buffett's recent investments in companies like Apple show his belief in the tech sector's robust future, despite his previous reservations about tech stocks. Buffett has also shown interest in healthcare, another sector he believes will offer substantial growth opportunities due to aging populations and technological advancements in medicine. His company's venture, Haven, in partnership with Amazon and J.P. Morgan, aimed at improving U.S. healthcare affordability, though it later disbanded, underscores his interest in this area. In terms of investment strategy, Buffett stresses the importance of sustainability. He believes that the investors of tomorrow will need to consider the environmental and social impact of their investments more seriously. This reflects a broader shift in the investment world towards ESG, environmental, social, governance, criteria, aligning with global trends towards sustainability. Buffett also continues to advocate for the value of American businesses. Despite global uncertainties and market volatility, he maintains a strong belief in the resilience and potential of U.S. companies. His long-standing principle of investing in what you know and trust seems more relevant than ever as markets navigate through complex changes. Finally, Buffett reminds investors of the enduring value of patience and discipline. He argues that a well-thought-out investment strategy, coupled with a calm and collected approach, will continue to be the cornerstone of successful investing. As he often says, our favorite holding period is forever, reminding us that long-term investments tend to smooth out short-term volatilities and yield substantial returns over time.